Welcome to the October 3rd, 2022 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, the weekly fast-paced tour of the global financial markets. Be sure to subscribe, share it with your friends that have asked you about what's going on in the markets. Well, there's gloom, despair, agony all over, but I'm going to take the picture of what's happening right now and then walk you through some of the things about the fourth quarter that we already know and some things that have already happened. Most people are investing or running in fear based upon things that, as Mark Twain would say, are just ain't so. And I'm going to show you some things that are true and that we need to know. This is S&P and the Dow, or no, this is S&P and the NASDAQ year to date. So NASDAQ QQQs represent the tech stocks primarily. And we can see right here, gloom, despair, and agony repeated this week. We had that June 15th bottom, and it looked like the bottom. Even Kramer said so on CNBC. But what happened this week? The Federal Reserve gave 17 speeches. Governors, presidents, and the chairman all had a speech. This is a record magical mystery tour for the Federal Reserve. What the heck were they doing and what was in those speeches? And why did it pound the markets? Well, one of the primary factors is the Federal Reserve. Keep in mind their objective. They want to squeeze inflation out of the system. Inflation may have already disappeared. I'm going to show you the evidence coming up in the other charts. What else are they trying to do? With inflation, they hate leverage in the financial system, right? Because leverage artificially props up the markets. They want to squeeze the rest of that leverage out of the system. It's a delevering process. And this week was one of the climaxes of their magical mystery tour to say, we'll do whatever it takes to kill inflation, including killing the economy. Well, everybody's saying, oh man, we could have a deep recession. Well, you've got earnings reports coming up in October. You've got inflation reports coming up in October. And not all those reports are going to be bad. And we've got evidence of that too. And the jobs report comes out next week, by the way. That'll be important. You want it just Goldilocks, just right. More people getting jobs, but you don't want that negative number because that's an actual contraction. But it would reverse course for the Fed. If the Fed reverses course in the fourth quarter, Katie bar the door, this was just a preview of what would happen with assets returning to what they're worth. And where do we want to be? Well, QQQ, the NASDAQ, tech stocks, it takes a long time for whatever was leading that got crushed the worst. NASDAQ's down 31%, S&P 500 down about 23%. That's bad. What's good? I took 4 medical dividend companies and their gains, 62% year to date, 8%, 15%, 17%. Not a recommendation for your portfolio till you come down and get a plan. When you come in, we do a brainstorming session. We find out where you want to be, and then we put that plan into action with tangible, valid mathematics on how we're going to get there. But take this combination, add it up, it's an average gain of 25% for the low-priced medical dividend companies. Wow, and they got good growth rates. Wow, energy sector, it's a 35% return just so far this year. And Goldman says oil likely to go back to 120 by year end, and they stuck to that forecast even though oil went below 80 this week. That's a wow. But they've got great cash flow. That's another clue. Global high yield bonds got pounded. Obviously the Fed saying we're going to raise rates relentlessly. We get that. But you've got bond funds at 75 cents on the dollar paying 10%. Well, that'd be 100% interest over 10 years if they keep paying that. Well, that's a pretty good starting point, right? What is this? 10-year Treasury note yield. Look at that. Went all the way to 4%, the highest since 2008. That's huge. Mortgage rates briefly hit 7 on a 30-year mortgage, came back a bit by the end of the week. now 3.7%. Jeffrey Gundlach over at Double Line, a great manager, he started buying treasuries, which was a very bold call. He's the only one I heard say that, but he said it when it hit 4%. Now let's look at this. October, I told you we're going to cover what's ahead in the fourth quarter. October, you got earnings reports. Major banks start on October 15th. Energy companies at the end of October through the first week of November. And we know those reports will be lots of cash flow. The banks are in great shape compared to 2008. In case you were worried it's going to be a global credit crisis, well, the banks are in good shape, at least the U.S. banks. Earnings season. A slight decrease in earnings, already expected. What happens to earnings after that, according to the learned analysts in Bloomberg? Well, they may be a little too optimistic, but they see earnings potentially rising by 20% between here and the end of 2024. Let's start thinking about where are things going to be in 6 months and 18 months, and what assets do we want to own, and how do we get a pay raise while everybody else is screaming Armageddon? Deflation. I'm going to show you pockets of deflation. We've been covering this, but it just became more important. This is the 20-city Case-Shiller Home Price Index. You can see the chart where you can get more detail and actually see it. That's on networthradio.com. I put all the charts and graphs in there for you, and the extended podcast with Alex is there too. Look at this. Home prices decreased for the first time since 2012. First time in 10 years, home prices went down nationwide. And where did it hit the hardest? You'll see a pattern here. San Francisco, 3.5%. Seattle, 3%. San Diego, 2.5%. Wow. Dallas was a minus 0.42, by the way. Record price cuts happening in the housing market. Housing boom appears to be over. And the inflationary impact of that appears to be over. And that corresponds to the mortgage rates. What's this? Lumber and copper. You need those if you're going to build a house, right? Whoa, they are both below last year. That's not inflation, that's deflation. Now we go to the food. What about the food shortage? There's wheat at the invasion. 1425 on this scale, 900 now. Wow, that's over a 50% decrease. And why would wheat be going down? It's still a little above last year, but that's not a food crisis, by the way. So you're seeing moderation in the grocery store prices. It started with beef, but you're likely to see it in other places. Corn is at least coming down, 818 to a 670. And then you have cotton. Wow, cotton is actually down 60%. And it's below last year. So if you were worried about an agricultural crisis, this looks more like deflation, at least over the last 9 months. That's a wow. Okay, what do we got next? Top 10, bottom 10 performers in the S&P 500, out of those 500 blue chips, supposedly. Who did the best and who did the worst over the last 90 days? Constellation Energy, In-Phase Energy, that's solar. And Netflix had a nice bounce back. Cardinal Health and Biogen. Biogen had 28% gain the last 90 days. On Monday, Biogen said, hey, our Alzheimer's drug is working. Well, they went from 197 to 304 in pre-market trading. And I made the comment, it's been a long time since I can remember what it looks like when a stock goes way up. So here on the bottom side, Newmont Mining, the gold down 30%, FedEx down 33%. They said we see a global recession. And I would say primarily because Europe is hitting the skids. Not so much in the US. We're seeing manufacturing expand because we've got cheap natural gas. We've got good electricity supplies generally. And Intel makes up part of that at a minus 30%. The tech wreck looks like it'll continue at least until December. So that's your fast-paced tour of the global financial markets. And the deflation news is actually for 2 months for producers, you've had deflation. That's likely to be repeated when you get the October inflation numbers for September. And if that deflationary trend continues, the Federal Reserve Magical Mystery Tour, the beatings for the market, could be over at some point in the fourth quarter. I'm Spencer McGowan, President, McGowanGroup, NetWorthRadio.com, McGowanGroup Asset Management, a team of 10, and the team collaborates on this research each and every week to bring it to you in a format that helps you make great decisions. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowanGroup, Apple Podcasts, Net Worth Radio, and NetWorthRadio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowanGroup Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at NetWorthRadio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At NetWorthRadio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowanGroup Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.